What's up, YouTubers? Thank you for hitting play on another episode of Gen Z CEO. My name is Andrew, and in this episode, I'm taking you through my top 3 ASX listed e-commerce stocks. The ones I'm buying now, I've bought in the past, and I'm buying well into the future. These are the ones that I'm backing. If you are smart enough to realize that the future of retail is online, then continue watching because these 3 companies are paving the way for the rest of the retail industry, at least in Australia. Please keep in mind that I am not a financial advisor. I have no finance degree. I have a degree in property economics. I just like to invest in companies that I think will do well in the future, and my strategy has done pretty well so far. I've made over 300% on my e-commerce stocks in the last 2 years. Again, I'm not a financial advisor, but I am financially invested in these companies, so I can speak from a degree of experience. Do your own research. Take this information on board, but do your own research and form your own opinion and make your own choices. That is the only way to invest without that small voice in the back of your head saying, what are you doing? It needs to be all you. But listen to what I say because this could definitely bring you some new value that you may not have considered before. Let's get into it. My top 3 ASX listed e-commerce stocks. Number 1, Kogan.com. I feel like we're all pretty familiar with Kogan as a brand now, and they have been a real front runner in the Australian e-commerce space since they first launched in 2006. Can you imagine launching an online retail business in 2006? Well, that is what Ruslan Kogan, the CEO, did. And he quit his 9-to-5 IT job to pursue an opportunity that he saw to sell flat screen TVs online at a super discounted price. By removing that brick and mortar element that, standard retailers had in their business model, he was able to mark down TVs by 100%, where they were selling flat screens for $4,000, he was selling them for $1,000 or $2,000, and it blew up. He had so much early success selling on eBay and selling through his store that he was able to scale very quickly. So since those early days, Kogan has had huge success and has become an e-commerce empire with a market capitalization of $1.7 billion. They have quickly branched out beyond consumer electronics into every retail subsector you can imagine. And they're not just in products, they're in the service sector as well. Kogan now offers things like insurance, mobile plans, internet, energy. Everything you can imagine, Kogan has become a central hub for. It's really not far-fetched to say that Kogan is quickly becoming the Amazon of Australia. So this year, Kogan really came into its own with all that fundamental business building over the last decade and, expensive system creation paying off when COVID-19 hit and consumers were forced to buy products online. Initial uncertainty around Kogan's Chinese suppliers and their ability to fulfill the orders that were coming in as a result of, this wave of online shoppers saw the share price dive pretty hard at the beginning of the pandemic, but that was fairly standard across the board. Almost the entire market plummeted. Kogan price dipped well into the low $4 range. I've been a holder of Kogan since last year sometime, but when that initial dive happened, I saw a huge opportunity to buy more stock at such an undervalued share price. I knew that all these retail investors were going to be scared that, they're not going to be able to get their goods from China and, the business isn't ready for this sort of thing. But I knew, an e-commerce brand that's been in the game for over 10 years obviously has the systems in place. I took a bit of a risk, but I put a considerable amount of money into the company at $4.50 or something a stock. And I've seen it grow 400% over the last 9 months. The fundamental shift among Australian consumers to online shopping has, really made the future of Kogan, a company that now lists well over 1 million products online, look very, very bright. Looking at the chart, you can see that their share price has taken a considerable dive in the last couple of months. And I think that's likely because of everything that's happening, around the world with the election and whatnot, plus also a bunch of retail investors taking their profits after the huge year that Kogan has had. But I am not doing that. In fact, I am buying more because I believe that Kogan is a company that is here to stay over the next 1, 2, 3 decades and continue to dominate that online retail space. this is just the beginning for them. And at $16 a share, it is very cheap buying. So number 2 is Wesfarmers. Yes, it's a blue chip stock, so immediately it's not as cool as Kogan, but it is absolutely cooked. How much of the market share this company is absorbing, especially in the online retail space. Just quickly, Wesfarmers own Bunnings, Officeworks, Target, Kmart, Coles, and Catch.com.au, just to name a few. There is a list of many more. I find it really hard to fathom a company that can manage this many businesses, but somehow they're pulling it off and they're doing it exceptionally well. This year, they have reached a market capitalization of, get this, $57 billion. So we're all quite familiar with the brands that they own. However, there is one in there, a dark horse that has really made a good run this year in 2020, Catch.com.au. Like Kogan, Catch was created many years ago, back in 2006, by a couple of brothers. It was originally like a deal of the day type marketplace platform where people could get killer deals, bargain hunters. That's where they would go, catch of the day. But last year in June, Catch was purchased by Wesfarmers for $230 million. Just imagine how many Lambos you could buy. Not even that, how many jets you could buy, properties, mansions, boats, whatever you want, $230 million cash. There isn't much you can't do with that. So after acquiring Catch.com.au for a small fee of $230 million, Wesfarmers imported 2 executives from Amazon to run the company, and they have done an exceptional job this year. Catch has literally become a household brand in the time span of 1 year, and yes, coronavirus has definitely played a big role in that. I am investing in Wesfarmers because you know what they say, some companies are too big to fail. These guys are huge, unimaginably huge. And yes, they are growing. So number 3 is Redbubble.com, and this was actually pretty tough because I was tossing up between Temple & Webster and Redbubble.com. I opted not to go with Temple & Webster because I look at their business, they're in the furniture selling space, and I just think they don't have enough competitive advantage. There's so many companies trying to sell furniture out there, so many companies created every day that sell furniture. I just don't know how long they'll be able to, outrun the competition. Whereas Redbubble is completely unique. Absolutely one of the most unique e-commerce stores out there, and it is big. Redbubble is a very smart and innovative company. They are miles ahead in terms of the technology that they have embedded into their e-commerce stores. They provide the most personal shopping experience that I have come across. I don't know how they do it, but I think that they're using really intelligent algorithms to identify what you as a consumer like, and they just filter out the stuff you don't, showing you only the products that they think and actually know you like. So it all comes down to your personal interests. For example, if they, identify and recognize that I like Bitcoin, they will show me hoodies, t-shirts, mugs, books, all of these, custom goods with Bitcoin sort of designs on them. And immediately as a consumer, I'm like, oh, these guys understand me. That's really cool. I like all these products because I like Bitcoin. And you feel understood as a customer immediately right through the door. And that is super duper valuable. The really cool thing about this company is it's actually print on demand. So they're like a third-party logistics company. So that keeps their overheads really, really low. Only when a customer buys something are they producing a product. So creators like artists and digital creators or anyone can come onto Redbubble, create a profile or a shop essentially, put their designs on any kind of product between, books, hoodies, t-shirts. Their product range is actually huge. Think print on demand stores, what you can print things onto. They offer everything plus more. So these designers upload their designs, put them on all these products, and then shoppers come and they shop all these unique designs on these items that offer practical value, like a coffee mug. They place the order, Redbubble fulfill it and ship it directly to the customer, and the creator gets a commission for creating the product, and Redbubble, I assume, is getting most of the profit margin out of that, and it's probably quite big because these are all just white good products. Redbubble are a prime example of a company who are dominating a space, print on demand, personalized custom goods, They are killing it and they are absorbing that market share, and any companies who's doing that in a niche is bound to be successful, and from there they can scale and create all sorts of products. This company is definitely a little bit riskier than Kogan or Wesfarmers, for example. However, I do have faith in their potential to perform long term. They are dominating the current space of print on demand. They are innovative, they are highly technologically advanced, and any company that brings technology and innovation together and makes it a really personal experience for you as the shopper is going to win in the long run. So they can take my money and they can leverage their current position. I will reap the rewards down the track when I make big gains. So definitely consider this one, redbubble.com. There you have my top 3 ASX listed e-commerce stocks: Kogan.com, Wesfarmers, and Redbubble.com. I am pretty keen to do a video 12 months from now and reflect on the progression that these companies have over the course of 2021. I probably will do that, but to be honest, it won't make a difference to me because I invest in these companies with the intent of leaving my money in there indefinitely. And when you adopt that mindset of very long term, it takes a lot of the worry and it takes a lot of the risk out of it because you know that you're invested in a company that's continuing to perform really well, and it's going to pay you off a lot more in the long run, 10x or 20x, as opposed to trying to swing trade these companies for 15-20% gains, and you're going to lose many more times as well. So it's definitely better just to pick a few companies, stay invested in those, and reap the rewards like 5 years or 10 years down the track when you've made some really, really good gains. If you enjoyed this video and got some value out of it, then hit that like button because it really, really helps the channel reach more people, and it takes you less than 1 second to hit the button. Like, why is it so difficult for people on YouTube to like videos? I don't know why, but that's how we grow our community of like-minded individuals, and we all become more informed as a result. It's an interweb of human minds. That's what we want to create. Comment below the stocks that you're interested in so I can do some analysis and maybe create some future videos on them, and subscribe to the channel because I'm always creating content on investing, real estate, Bitcoin, entrepreneurship, and I like to also interview really successful individuals. So that's it for this video. Stick around for the next one and make some money in the meantime. Peace out.